touched a few issues because we've got a good turnout tonight, even though it's a cold night. So quite a few changes in the budget on the superannuation side of things. So most of them are actually positive, so we'll go through that later. But the key thing is, from the budget's point of view, the easy target has been superannuation because it's one of the areas where governments have been costs a lot of money for superannuation as a general rule for the budget. So people say it's up to $35 billion a year in costs for superannuation through the fact that you're getting tax deductions, through the fact that you've got tax-free pensions. When you add all that up, Treasury's come up with a figure around $35 billion. But if you look at the total cost of age pensions, it's about $35 billion. So in fact, they're saying that the whole cost of the budget expenditure on superannuation is equivalent to what they're spending on age pension. So it's quite a big tax cost for the government. So I'll go through some of the issues with all the changes, but first to go back and look at some of the big issues with the budget. And the main issue is that we're looking at where the money comes from and where it goes to. The biggest issue is that most of the money from the government comes from individuals, you and me, paying our PAYG tax. So about 71% of government revenue comes from that. So it's not coming much from company tax, that's the other one, that's the second biggest one. And then sales tax and the GST is the third one. But for most of it, nearly 3/4 of the income comes from PAYG individuals, and we'll show you why that's a big problem for the government in the future. The big spending issue is social welfare. So that works out to be about 35% of total spending goes on to aged care, disability pensions, age pensions, child support pensions, all the benefits that we get through redirecting government spending. Health's another one, about $71 billion. That works about, health is about 16%, and the other big one is education, about 7%, which is a much smaller proportion. And then you get to smaller ones down here. So the big ones are social welfare and health. And again, we'll talk about health in the future because that's going to be one that's going to expand over the next 15, 20 years. So that's where the money's going. The next issue is that we've had a lot of... Going back the other way. Go back there. So the next thing is that we've been running deficits since about 2008 when we had the GFC hit. As you probably remember, Kevin Rudd inherited a surplus, a $20 billion surplus, and he quickly spent that and made it a deficit. You can always argue whether he spent too much or too little, but we got through the GFC. And we also avoided having a recession. So the main issue is if you have a recession, you usually end up with 10 to 12% unemployment. You end up with quite a lot of people who are underemployed as well, and you also have a big drain on the government for social welfare because they've got to go on age pensions. Unemployment benefits. But the deficits have been up and down for the last few years. The aim here is that we start to reduce the deficits from now on up to 2020, so another 4 years to reduce these deficits. And then we'll have a small cash surplus from around 2020 onwards. There's some valiant attempts by Wayne Swan here to try and pull the deficit back. He used a number of tricks. He brought forward revenue and took some of the outlays to the next year and tried a few little tricks there, but ultimately we've been running around about 2% GDP deficits for a number of years, and we're trying to get that back. So overall the deficit's currently around 2% of GDP, which is not serious by international standards. Some of the European countries have been running 3 to 5% GDP deficits for some years. And they don't seem to want to get back into deficit. At least we want to try and get back into deficit. There's been valiant attempts, as I said, by Swan. Chris Bowen had a go, and then we've had Hockey had a go, and now we've got Scott Morrison getting back on track. The main issue is that we're running about a $35 billion deficit this year. It's been getting, basically, if you look at the cash balance, getting worse there for the last few years, and hopefully getting better. One of the interesting things is the percentage of income coming in from, the amount of actual claim on GDP has been rising. So if you go back a few years, we had about 24% of GDP going to the federal government in income, and now we're going to hit just a bit over 26%. So there's another 2% of GDP going towards the federal government. So they have been increasing their revenues, but expenditures have been going up at a quicker rate. So it's not as if these revenues have been collapsing, it's just that we can't, our spending's getting quicker and quicker. You can see back in 1985, 86, you have to go back a few years, we were spending around 28% of GDP. That was roughly the Hawke era. Then it went down, came up again and up and down. So but this period here was really basically the end of the the 82-83 recession. As I said, when you have a recession, you have less taxpayers and you have more people claiming the New Start allowance and unemployment benefits. That's why that went up and then came back over the succeeding years. But we don't have a recession. We haven't had a recession since 1991, which is here. Again, a recession, you have spending going up and then it declined over time. And then you had spending rise again in around the late 2000s and then decline. So we're in a situation where we've had a rise in spending as a total of GDP. Now this is the interesting one about where we're going to go for the next few years. The government's saying that they'll get their spending under control by around 2020. There's a couple of projections here. The official projection is to reduce the GDP as a percentage of, this is the projected debt down to 10% by 2026 by some surpluses. Access Economic, which is the Chris Richardson, his projection is that we will still hang around 20% GDP debt for all through the 2000s. So he's not thinking that we're going to get the debt down, he's thinking it's going to stay at around 20% of GDP. There's another projection there we won't go into, but basically we're not hugely over-debted as far as the country is concerned. 20% GDP is on the very low range, and many other countries are around 60 or 80 or 100% GDP. Yes, sorry.
At the risk of sounding stupid, which I am, but I keep forgetting what GDP is.
Oh, just the total production for the year. Sorry, I should say that.
Gross domestic product.
Yeah, that's right. So adding up all the things we produce for the year and getting a value for it. So like it's total income really for the year. So in percentage terms, it's not bad by international standards, but we've got to remember that the next 20 years, the baby boom generation is moving into retirement, and they'll be claiming two things. They'll be claiming aged care and age pensions and health care. And those things we really have to prepare for, and I'll show you a reason why. But over time, the government's being optimistic that we'll get back to bring back our payments and increase the receipts up to around 2020. So that's hopeful, depending on if you don't have a recession and you don't have any major cost blowouts. But of course we're in our election now, and of course it's always tempting for politicians to spend money they haven't got. Only last week, a couple of weeks ago, the government spent money they hadn't got, and that was to spend $50 billion on submarines. Now, they didn't put extra money into for that. It's going to be 3 to 5 years before it's a claim on the deficit on the government, but they haven't put any extra revenue into cater for those submarines they're going to build over in Adelaide and around Australia. So hopefully we get our into a surplus by 2020, and that's a bit of an optimistic projection there, but we'll have to go with it. But one of the things we've got to bear in mind is that we've really got this life expectancy going up, and this has been done by Productivity Commission, but since 1965 we've really had about a 20% rise in life expectancy up to today. Now 20% doesn't sound like much, but that's another 5 years in retirement. So what we're saying here is somebody now is living about 31 years in retirement for a female and 29 years for a male, whereas it used to be around 24, 26. Now that extra 5 years is when you are more in ill health, you need aged care, and you also are still drawing on an age pension. So there's quite a bit of extra cost in that last 5 years in your age retirement. So the other problem we've got is that there's less and less people in the workforce. That's because the baby boomer generation was such a big bulge in the pipeline that we're going to see a lot less people from now on in the workforce. So today we're around 4.5 people in the workforce per every one person retired. It used to be around 7 people back in 74, 75 when we had high migration and high fertility rates. But now we're going dropping until around 2050 we're around about less than 3 people in the workforce to cover the cost of aged care and people in retirement. So these numbers are just eroding the tax base for the government, and they're not going to change unless we get some massive amounts of migration into the country. We've already had a lot of migration over the last 10 to 15 years, but you'd have to have a lot of migration to change those figures. So when you start to look at it to, say, 2050, the costs for the government are really going to escalate. So aged care roughly doubles from what it is today. Healthcare roughly going up 50%. Education's not really changing because we don't really have as many kids in schools and that sort. That's not going to change much. But the aged care and pension and service pensions going up about 30 to 40%. And other payments are declining. So the big things the government's got to cover for is aged care, health and aged pensions. That's the big cost that's going to really hit the government over the next 10 to 20 years. And they're not going to have the taxpayers to support it. So this is a projection that New South Wales government did on their escalation of health costs. So basically it's saying the government health spending up to 2030 has got to grow by about 6.3% a year. Now inflation's only 2 to 3%, so it's going to grow roughly double inflation. So healthcare for the government overall about 6%, federal government spending around 5.8%, states healthcare spending about 5.5% a year. The increase to federal transfers to the states for healthcare around 4% a year. And by 2030, there's a $35 billion deficit down here that the states can't cover. Now, you probably heard that a few weeks ago, the states were offered to be given the GST, 5% increase in GST. They didn't want that. Well, some did, some didn't. They were offered to have their own taxation. They didn't want that. So the states have got this problem. They're going to have this deficit rising. They're going to fund it from somewhere. Now, we don't know yet at where they're going to get the money from, but they can't just keep running up debt. They've got to come back and somehow tax people. Whether they get it from the Commonwealth, that's the big issue. They'll probably try and get the Commonwealth to pay for it because it's less a problem for, well, that's the idea is to get the Commonwealth to collect the taxes. But at this stage, we've got this massive amount of run-up in healthcare spending that is going to be unfunded. And there's a $50 billion cost for the submarines as well. And that's not factored in there either. So coming back to what we've been trying to do for most people is trying to get people off age pensions. The social welfare system is still there, will be still there in 2050, but we will hopefully have only 30% of people on full pensions. And that's because most people are now coming through the system. Our children will be coming through the system with at least 9% of super, 9.5% of super for most of all their lives, whereas a lot of people in Australia hadn't had full superannuation for all their lives. So we will see a dramatic decline in the number of people on full pensions, but we won't see any change in people who are completely self-funded. So that means still 20% of people will be self-funded, but we would have hoped that a lot more people would be self-funded in this situation. So a lot more people go on part pensions, still draining the government, but it's better than what it would have been if we had a lot more people still staying on full pension. So we have $2.6 trillion in superannuation, so that's pretty good by international standards, but even so, it's not going to fully fund a lot of retirees through retirement. So what do we have to do to get the government back to cover the cost of baby boomers? This is an estimate. By 2030, most countries in the world, we're not the worst. A lot of countries like Japan and the US are a lot worse. We'll have to spend another 5% of GDP just to cover the cost of the baby boomers going through the system. It's aged care, health care, and aged care homes that they've got to cover. So that means if we're on roughly 26% of GDP, you've got to get up to 32% GDP as the government's taking in taxation. So that's a massive amount of more taxation that's got to come through the system. So the government's optimistic that by 2020 we'll get back into deficit, into surplus. But what we're seeing here is, I think we're seeing that these figures are going to tell a different story once you get to 2020. So let's go back to the budget now and see what's happening there. So what the government, as I said, use this easy target superannuation because it impacts you now, but you don't really have, it hits now, but it doesn't have an impact until you retire. So they're really sort of taking away money from you now, but you'll really only see the net benefit or net reduction in your age, in your superannuation when you retire. So the first one is a lifetime cap on superannuation. Now, this one is putting your own money into superannuation. So they're saying you can only put your own money up to $500,000 in your lifetime. And they're going to backdate that to 2007. But the key thing here is that most people only put money into their superannuation when they retire. Typically it's when they sell a house or inherit some money. And $500,000 is not too bad. We don't get many people going more than $500,000 into superannuation. But it still restricts you in what could be a very tax-effective way of getting your retirement looked after by getting it into superannuation, then moving over to a pension, and from age 60 taking a tax-free pension. So a bit of a limitation there. The current limitation is that you can put $540,000 over every 3 years. Now, the government's saying that's a bit too generous, and they're cutting it back to $500,000 for your lifetime. Don't see too many problems with it, but it may restrict some people from putting money in superannuation. The other one was they're changing the threshold for income tax. There's a bit of a giveaway. So instead of being $80,000 when you start to pay your 37% tax, it's now $87,000. Now it's a little bit of a giveaway to middle class Australia who are going to fall into the second highest tax bracket. It's going to basically give those people an extra cup of coffee a week, but it's not a huge one as far as giving much away. The other thing is to reduce business taxation. Now, as you've probably heard, a lot of multinational companies are trying to avoid tax by moving their profits overseas. One of the ways you can reduce that drive is by getting the tax rate down in Australia compared to many other countries. Many other countries have a 10-15% tax rates. Singapore's about 10%, I think Ireland's 10%. Even Britain's down to 17% tax rate on their companies. So if you lessen the tax rate, there's less incentive to move profits offshore. Now we're we're one of the highest company tax rates in the world. The US is higher, they're about 40%, but we've got one of the highest tax rates in the world. So the idea is, one, to give an incentive for companies to invest, because if they're not taxed as much, they've got more profits. But the second thing is to reduce the incentive to export your profits overseas. We're also going to do a lot more on the front of chasing the multinationals on avoiding their tax. They're employing over 1,000 new people in the tax office to go and chase them. They're getting highly qualified people, accountants, solicitors, in to actually do the chasing, so they're going to be highly qualified people to go in and do audits on the multinationals and try and find out where the money's going. But the main idea is that if you give a small business a concession, they're the biggest employers in Australia, they're small and medium-sized business, up to $10 million. in 16, 17, get them an incentive to go out and invest in new business, put in new machinery, take on new people, because their tax rate won't be as high. The negative one, though, is on superannuation. As I said, it's an easy target. They're going to try and, well, reduce the maximum you can put into super as concessional contributions, that's your employer money and your salary sacrifice each year. Reduce that from $30,000 for people under 49 to $25,000, and the same figure for over 50s, over people over 49. So that's a real pain, because we try and get as much into super before you retire. Often it's only the last 5 or 10 years of your working life that you've got the opportunity to do that, and so that's going to knock around some of our plans to get the maximum into super for the next few years. Now, of course, you've got to remember this is only the proposed budget, hasn't gone through Parliament. It's got to go through the election, and then the government's got to get through the Parliament. So don't get too worried just at this stage, but it's really a one that from 17-18, not next financial year, but the financial year after, potentially we've got a big drop in what we can put into super as concessional contributions. This one is a really interesting one. This is one for people who are putting money into super to claim a tax deduction. Now, you probably know that a lot of people in Canberra who've got incomes over $37,000 from comp super pensions. We can reduce your taxable income by putting a super contribution in, because people who've got comp super pensions, they're unfunded employees up to age 65 currently. So if they put a super contribution in, they can reduce their tax down to a very small amount. Now, this opens the door to do that until you're 74. So it means everyone who's got a comp super pension over $37,000 can keep reducing their tax every year until they're 74. So it's probably written by a public servant, I guess. So, so it's a great concession there. It wasn't really picked up by the newspapers, but because what they're saying is people who are not working, want to reduce their tax. They might have income from shares, they might have income from rental properties, and they haven't been able to claim a tax deduction because they haven't been employed. So let's say they had a 50 grand income from rental properties, they can now put, say, $13,000 into super to reduce the tax. But this can be anyone who's got an income that's not from an employer can now put money into super. That's that proposal, so it's not a bad one. So that applies from 2017. So that's a positive, that's a good positive one. So that was the idea that from 2017 they can claim tax deduction for personal contributions, even if you're not working. A negative, this one's a lifetime limit of $1.6 million that you can transfer into an allocated pension. Now, this is a fairly high figure. There's only 3 of my clients who are affected by this, so it's not going to really affect too many people. But all it does is say that you can't put more than $1.6 million into an allocated pension and get it tax-free. Now, if you do have one already, don't panic, because all they do is say is up to the $1.6 million worth of funds, you can claim that tax-free, but above that, you have to get taxed at 15%. Now, for a lot of people, that won't be a huge amount of tax anyway.
So, Russell, if you've got a number of a few allocated pensions,
they'll add them all up, and then you'll have to, I'm not sure, there'll have to be some information swapped between the pension funds, I'd say, but it's not going to affect a lot of people. The other option is to make it simple. You could just transfer the money over $1.6 million back into superannuation, and then it's segregated, and then superannuation is paying the same tax at 15%, or you can just leave it there. They'll just have to work out the administration of that. So I'm not sure if the government's really thought about how they're going to work it out, but they're probably going to get you, the tax office, to collect a figure of your total superannuation on 30 June each year, and then send out an assessment back to the super funds. They may proportion it when you've got 2 or 3 funds, I'm not sure, but they'll have to work out something. I'm sure some of the tax officers have worked it all out, hopefully by now. So, earnings on investments in transition to retirement pension. Now, you probably, some of you may have been doing this already. Won't affect you until 2017, but what they're saying is they're going to tax you at 15%, where it's 0 tax currently. probably not going to affect you too much in the sense of amount of tax you pay, because a lot of people are getting a refund on their allocated pensions anyway through the franking credits. So what does it mean is if you've got roughly 30% of your money in shares inside a pension fund, you're getting franking credits on 1/3 of your income. That usually meant, well, in an allocated pension means you pay no tax and you get all those franking credits back. It'll probably roughly equal out that the franking credits will probably equal the tax in this case. So not a huge amount of tax, but it's just changing the status from those transitional retirement pensions back to a taxed investment, but at a low tax rate. Negative gearing, no changes, which is obviously the big difference between Labor and Liberal. The Labor Party says that they were going to stop anyone claiming a negative gearing on new properties from, I think it's 1 July 2017. Now, their idea is they're trying to allow the first home buyers to be able to get into new properties because what they're trying to do is increase the supply of new houses. Because if you have more supply, that'll keep the price of houses down. So what the Labor Party wants to do is only allow negative gearing on new properties because that increases the demand for new properties and allows first home buyers more opportunity to buy either older properties or newer properties because there's more demand. Because negative gearing is really a tax subsidy. Because the tax office is giving you a subsidy to lose money every year on your property and you'll hopefully make it back on the capital gain. The Liberal Party is saying, no, we're not going to change negative gearing because they're saying that all investors who get gearing advantages are helping either the rental market, that is, if they buy into the housing market, they're going to provide a house for rent for someone, which keeps the rental prices down. And their argument, the second argument is negative gearing also creates demand for new houses because either the property can be negative geared in the new houses, so it creates demand for new houses as well. So they're sort of arguing a bit on. They're saying that negative gearing, in a general sense, creates more housing and cheaper rents. But they're going to keep it at this stage. Age pension changes. Now, no changes have been announced in age pensions or other social security benefits, so that's good. But you've got to remember that we have already had a change in age pensions which were announced in the last budget. And this is the change in the assets test. Now, a lot of people in Canberra are not affected by assets test, they're mostly affected by the incomes test because their ComSuper pension is fully assessable. So the big change is for single people who are in homes, is they're going to drop the assets test from 804,000 to 547,000. So that's a big drop, and that's going to mean all these people above 547 lose the age pension completely, and they also lose the age pension card, which is your rates, gas, electricity, water, pharmaceuticals, driver's licence and rego. So there's quite a lot of lost benefits there. The only thing they do get is a seniors card, Commonwealth Seniors card, which will give you pharmaceuticals and the carbon credit refund, carbon tax refund supplement. So it's only $90 a quarter. So there's a big loss here of benefits. One is the age pension and two, the card. So there's, in total, 190,000 pensioners will lose their pension completely. And some people will have their pension reduced at the top end, but some people will have their pension increased at the bottom end. Because what they're doing is two things. They're contracting the top end, but they're also increasing the threshold at the bottom end. So there's a lot more people here who are on the lower bottom end will actually get more pension. So there's two effects. Some people getting more pension, some people losing the age pension, and some people losing a little bit of age pension. For couples, it goes from roughly 1.2 million back to 823,000. So a lot of people will miss the age pension here, but you've got to remember they've got more than 800,000 in assets, so they'll all be fairly wealthy. They'll potentially. Yeah.
Does that include your home?
No, it doesn't include your house.
Oh, right.
So
other assets.
technically, if you wanted, as a strategy, you could go and take your investments, buy a big house, and still get under the assets test. But, yeah, you can buy a waterfront home in Sydney. But they might eventually change that too. So again, the threshold is raised at the bottom. So there's people here at the bottom end who will now fall into the category of a full age pension. But when it does cut in, they lose more pension much more quickly. So under current rules, for every $1,000 over the threshold, you lose $1.50 pension. Now you're going to lose $3 pension. That's why it cuts out much quicker. So when you start to cut out, it cuts out quicker. For people who don't own a home, not many people don't have a home, but this cuts back from 1.3 million down to $1 million. Now this is the area where it's probably from people in aged care. So you probably know that when you're in aged care, you're considered a non-homeowner. If you're in high care, they will have that changed as well. So that may affect some people in aged care. So now some changes in the tax on superannuation. Now most people in this room won't be affected. This is for incomes over $250,000. So in the past, if you had an income over $300,000, you lost another extra 15% tax on your super contributions. What they're going to do is increase that. That increase will go to people who earn over $250,000. So not too many people in this room will be affected, but what it does is just it taxes them another 15% on their contributions as they go in. Now this is we talked about the $500,000 before. So the details of this is that they're going to go back to back to 2007 and look at all your contributions you put into super as your own money. Now, if that's over $500,000, you keep it, but they're going to take account of all those contributions going back to 2007 and say that's part of your $500,000 cap. Now, for a lot of people, the only contributions you make generally is when you may put in 5% into your super fund or 10% into super fund, like PSS people. They put 5 to 10% into super to get extra contributions from the government. That will be counted. So we might have to go back to super fund contributions. It might be $5,000 or $10,000 or $15,000 a year, going back to 2007 to see how much you put in before we then put in a lump sum. So it's going to make it a bit more complicated. It means we're going to have to check a bit. If you go over that limit, and they find out about it, the tax office will check. You'll have to take that back out of the superannuation scheme. So there's probably an option you could put a bit more in there and just wait for the tax office to tell you that you've put too much in. But we'll see what happens on that one. But anyway, because superannuation is the best tax saving we've got, superannuation allocated pension. So they're trying to limit the amount going into super. They're saying, okay, it's good to put in $500,000 if you can, and they're really trying to limit the amount of super contributions up to $1.6 million because the amount you can transfer from super to pension, tax-free, and getting a tax-free pension is $1.6 million. Still a good number. So, obviously there's a target income you can get $1.6 million to super for your retirement. Now, catch-up superannuation contributions. Now, in the past, as I said, you had this system where you could put up to $540,000 for every 3-year period. That's going to be replaced by now the $500,000 cap limit. So this was obviously better because every 3 years you could put over $500,000 in. But anyway, the government's trying to close that loophole. Now this one here is on concessional contributions. We said before that they're going to reduce the amount you can put into super down to $25,000 per year for everyone. What they're going to say though is if you don't put in your $25,000 in the previous years, from 2017, so from 2017 if you only put in $10,000 one year, you carry forward $15,000 worth of surplus funds you can actually put in the following year, any following year after that. So they're saying that in cases where people have situations where they have only come into money when their kids leave home and they've paid off their debts, they can use this surplus amount to put in extra contribution in following years. So they might be able to put in, say, $40,000 a year if they've had a couple of years where they put very limited amounts into super. But it only cuts in at 2017, so it's going to take a while for that system to work, for people to do a catch-up. But the government's going to argue, well, you were able to put 35,000 in the last few years, so for most people, so there's going to be people caught in the middle of this sort of process. But basically it's saying you can carry forward the gap, what you haven't put in, into following years. Then, as I said, this one is an interesting one. Putting in super contributions from 65 to 74 gives people an option to put in superannuation even if they're not working, which we can't do now. You've got to do a work test to get money into super if you're over 65. And that work test is that you've got to be working at least 10 hours a week for 4 weeks in a row. And you've got to be able to show that, you've really got to be an employer, be able to provide a group certificate so the tax office can check that you're employed. From this time onwards, from July 2017, this goes through, you don't have to do that. You can just have a way of getting your tax down by putting money into super. That's right, so that's all that. Superannuation contributions, as I said, 1.6 million can be in your pension fund, tax-free, and have a tax-free pension. Earnings on your investments held in pensions, well, that's right, up to 1.6 million, zero tax, above that, 15% tax. Transitional retirement pensions, as I said, they'll be taxed now 15%. And personal tax income changes at the rate from 80,000 to 87,000. So the only tax bracket that's going to change is this one here from 37 to 87. Everything else stays the same at 37. And 45% for people over $180,000. Now, as you know, there was a 2% extra emergency budget measures, 2% tax on those incomes over 180,000. That drops out in 2016. And this is where Bill Shorten says there's the guys who are on 180,000 are getting $17,000 extra tax because this one was only an emergency measure. And so he's saying that 2% is where you're getting this big tax bonus, whereas people down here are only getting a few $100s in tax benefits. So that's how his argument. Spouse contributions. This is an interesting one because in the past it's a very limited amount we could put in for spouses. Now, often the spouses are at home working or looking after children. So if she's in the case where the spouse was only earning $10,800 or less, you could put in $3,000 in super. Now they're raising it to $37,000. Now what they're saying here is that a lot of spouses do earn, something like 10, 20, 30 grand. They're allowing them to put up to if you got up to $37,000 income for the spouse, because she's on a low income, maybe doing part-time work, picking up the kids after school, the husband can then put in $3,000 into her super. And then he gets $540 off his tax. So it's a way of recognising that there's a lot of people where you've got two incomes, but one income's very low on one spouse, and this allows the other spouse to put money into their super. Now, for a lot of people, this is not going to be really taken up. We've never really seen many people being able to use it under the $10,800 limit. I doubt if many people will use it at 37. And the reason for that is because if you've got income with a low income spouse, usually it's because the spouse is home, spouse has got children. When you've got kids debts and children, you don't have to spend money anyway, so I'm not sure if that's going to be taken up much. Second one, the temporary budget repair levy, that refers to that 2% on incomes over 180,000. That expires. It's already going to expire anyway, and they're going to allow that to expire on the 30th of June 2017. Company tax rates, they're trying to get that down, as I said, from 27% down to 26, down to 25 for all companies. This is for 27% currently for incomes, revenues over 10 million, and it will extend to large business later on. So eventually they're trying to get it down to 25%, which is still high by international standards. Most countries have got a tax rate of less than 20% for their companies, and we're way out of line, as I said, with most other countries. Germany's a bit higher than us, but most other countries are much lower. So there's been a lot of changes in the budget, mostly on superannuation. Not really any major tax increases, but the tax increases are only really hitting the very wealthy. and they're not really hitting the average person. Now, obviously, with a government that's got going to election, they really couldn't go out with a very strong budget. So my guess is this is really the lull before the storm, because, as I said, there's so much costs coming through the system. One, with the submarines, two, with healthcare and aged care costs, that they can't really, the governments are really going to have to face some major increases in taxation in the future, where it's going to either be revisit the DST, increase income taxes, or increase other taxes. So we've got to really understand that the government's been spending a lot more money than they're drawing in. $37 billion is around 2% of the total GDP. If you work it out, for every $12 the government spend, they're borrowing $1 just to keep things going. Now, it's not nowhere near like the Europeans, like the Greeks or the Portuguese or the Spanish. They're nowhere near that level. But if we're going to have money in the next 10 or 20 years to cover for aged care, we can't be really spending too much now. And that's really where the urgency comes in. The Liberals were elected, as you probably remember, one of the issues was to try to repair the budget. They haven't really been able to do that because they were blocked in the Senate. Now, who knows what's going to happen with this election? But whatever government goes into power, they still can't get away from the fact that you've got less people working, more people going onto age pensions, and you've just got a general increase in the number of people over 65. So that's just inevitable. We can't change that, and there's just got to be some give in the system eventually where they're going to have to tax people more. How they tax people more, we don't know, but that's going to be the next few years. Is going to really be the next few budgets from now on. I guess is going to be where we're going to have to really start to cut back on expenditure or raise taxes. So anyway, but not too much drama there tonight, I don't think, for most people. But any questions on this stage? Yeah, Jim?
A bit confused. At one stage on the board it said you could have $500,000 in the pension fund.
No, that's 5,000 putting new money in, your own money. That's what we're referring to. You can have as much money in your super fund as you like, but you can only transfer $1.6 million now into a pension fund that's tax-free. So the $500,000 is what you put in yourself, your own personal money.
You mean after tax money?
Yes.
Oh, yes.
That's right. So it's your own money, effectively coming through from either inheritance usually or selling a parental property. They're the two things where most people get a lump sum. Or sometimes redundancies, people have to spend money over from redundancies.